So now it's my pleasure to introduce you to Anu from British Patient Capital. She's probably one of the most important women in the UK in terms of being able to access, I think, 2.5 billion pounds worth of capital that gets invested into venture capitalists. And so I can think of no one better to moderate the next panel on how to raise money from institutional investors. Anu?
Thanks so much, Gary. As Gary said, I'm Anu Adebayo. I'm with British Patient Capital, and we are a commercial subsidiary of British Business Bank, which is the UK government's development bank. And BPC itself, we're actually the largest domestic investor into venture capital funds. And we have, as Gary said, 2.5 billion to invest over 10 years. I also am a venture fellow at the Fund London, and that's part of a international community of founders and operators that invest into pre-seed companies. So with that, I'd like to introduce the panel. So if I could introduce Jewel Burke-Solomon, and she is the head of Google for Startups US and managing partner of Collab Capital. Emma Steele from Ascension Ventures, Ed Zimmerman of Venture Crush, Lorenzo Thione of Angels, and Paula Groves from Impact X Capital. And hi, everyone. Welcome.
Hi.
Hi. Hi. I think we've lost Jules, but we'll start the intros and hope that she will. Here she is. Hi, Jules.
Hello.
Hi, Jewel. Fantastic. Let's start with intros. And Jewel, you're actually first. If you could introduce yourself and your firm and tell us what you do, please.
Certainly. Good morning, everyone, and good afternoon. I'm here in Atlanta, Georgia. So excited to be participating in London Tech Week and here with FounderTribes. My name is Jewel Burke-Solomon. I am head of Google for Startups in the US, and I am also managing partner at Collab Capital, where we are dedicated to investing in brilliant Black founders across the US. I'm super excited to be here this morning.
Fantastic. Thanks so much, Jewel. And I'll go to Emma next. Please introduce yourself.
Hi, everyone. Thanks for having me on the panel. I'm Emma Steele. I'm an investment director at Ascension. I've been with Ascension for 4 years now. And Ascension is a pre-seed UK investor. We have a number of fund structures, including quite a few impact funds, which is my remit. And one of the funds, for instance, is an institutional fund looking to reduce the poverty premium in the UK. So I think a lot about impact in the social sense as well.
Thanks so much, Emma. Ed, if we go to you next, please.
Sure. Ed Zimmerman, and I guess I have a couple of jobs. I'm a partner at Lowenstein Sandler, where for the last 30 years, I have represented startups and venture funds, even when that was completely irrelevant to the rest of New York City, which is where I've been for that period. I'm right now actually in Reykjavik, which is why I'm wearing a hat. It's a little cold here. I have for years been angel investing and LP investing after paying off some massive student loans from the early 90s. And my wife and I and a couple of friends formalized the LP side of that into something called First Close Partners, which we founded last year, through which we continue to invest in as LPs in venture funds run and founded by underrepresented managers. So through First Close Partners, we have invested in more than 55 venture funds in the US, Africa, Europe, LATAM, and the Middle East. And we're continuing.
Thanks, Ed. Next to you, Lorenzo.
Hi, I'm Lorenzo Thione. I am a managing partner at Angels. Angels is the largest venture investment syndicate in the world, and it's actually the only one that is dedicated single-handedly to supporting diversity in leadership at all levels of the venture capital ecosystem. That means supporting diverse founders and diverse teams, as well as companies that embrace diverse leadership, where we help them with talent and board diversity recruitment, as well as bringing true diversity on their cap table. We've invested in over 600 companies, having overall deployed over $300 million from our entire syndicate.
Fantastic. Thanks, Lorenzo. And then last but not least, Paula, please introduce yourself.
Hi, can you hear me?
Yes, we can.
Great, thank you. My name is Paula Groves. I'm Chief Investment Officer at Impact X Capital. We invest in underrepresented entrepreneurs all throughout Europe. We are targeting a $100 million fund to provide capital to these entrepreneurs, and I look forward to participating in the conversation.
Fantastic. Thanks, Paula. As we get started, I think there will be some time for Q&A at the end of this. So if anyone has any questions, please do put them into the comments, into the chat, and we'll hope to get to them at the end. So I think the way to start today, I think, would be to start by framing the kind of scale of the problem. And I know in the video that we watched, the FounderTribes video, there were some of these statistics were in there. Data just shows that underrepresented founders have disproportionately less access to funding. And there was, I think, some of those figures were definitely from the Extend Ventures 2020 report. And just to kind of highlight some of them again, over the last decade, in the UK, only 0.24% of VC funding went to teams of Black entrepreneurs. If you add in other multi-ethnic communities, that goes up to 1.7% of VC funding. 68% went to all male teams. 3% went to all female teams, with the rest going to mixed teams. And I suppose the worst statistic of all for me was the 0.02% that went to Black female entrepreneurs. So we can see the data shows the scale of the problem. And be really interested for us to go into why we think that's the case. Why do underrepresented founders struggle to access to capital? What are some of the barriers that are in place that you will have come across as you've been working with founders and also with VCs and others in the ecosystem? And open for whoever wants to go first on this.
Well, I'll jump in. I think the video that we just saw also did a good job of trying to get at why this problem exists. I've been investing in underrepresented entrepreneurs since I graduated from business school in 1992, and the clear problem for me is the numbers that you just quoted today have been the same since 1992, since I've been involved in the industry. Nothing's changed. I think one big problem is getting known. Silicon Valley is a very insular community. They invest in people that they know. Venture capital is a risky business. And in order to find comfort, people find comfort, it seems, in people that either look like themselves or they went to school with, they were on the crew team with, or was somebody's bridesmaid. And if you're not in that community, if you didn't go to schools in Silicon Valley, or if you didn't go to, I think I've seen similar statistics around people who attended Ivy League institutions or elite institutions, if you didn't come from that community, it's very hard for them to get to know you or to trust you because you're so different than they are.
Yeah, I'd say I agree with that. Specifically in venture capital, the entire kind of thought process of assessing an opportunity is to try and find signals that de-risk, I suppose, the early stage proposition. And if you already start with a pool of capital that is non-diverse in the way they're thinking, that you have a whole set of biases that people just aren't aware of when they're looking for those signals of comfort and de-risking. And yeah, I mean, this is a start to look at how diverse funds are, in order to try and get over, or at least be more mindful of the biases that people have naturally when you come to decision making. But also, yeah, the network element is huge. That's it's more of a structural issue beyond VC. But accessing VC, to be honest, anyway, is quite hard. So accessing VC when you are excluded or underrepresented is even harder. So, I think the only solution to this is improving the democratization of or the openness and transparency of access to VC in general, like make it less about network and more about open pitching.
I just want to add one thing and also amplify Paula's point, although respectfully disagree with Emma, and maybe I'll start there. When we talk about unconscious bias, we tend to trivialize the overt racism, homophobia, and misogyny that is the real reason why it is harder for people who don't look like I do, who don't present like I do, who don't love like I do, in terms of who they love. And people who look like me and who live in major sources of capital spots like London or San Francisco or New York and very few other places have explicit bias. And I think it's useful to call us on it. We created the problem, we benefit from the problem, we meaning people who look like I do. And we perpetuate the problem, and we read about it, we know the stats, so it's not implicit because we're on both constructive notice and more recently actual notice. And to Paula's point about those numbers not changing since 1992, when she and I graduated from school, I published something in 2013 in the Wall Street Journal quoting stats from 2011 that 87% of all venture investors in America were white, 89% were male, and 52% had gone to the same 10 universities, reflecting a homogeneity of background and therefore of insights and perspective. And it has been self-perpetuating because we have premised the system on warm intros and on vouching. And those two things, warm intros and vouching, are inherently racist, misogynistic, homophobic, transphobic, unless we move through the world with intentionality and develop truly differentiated networks, meaning networks of people who don't live where you do, who didn't go to the schools you attended, who are from different socioeconomic strata, and who don't look like you.
Echoing all of that, I was gonna add much of what Ed was saying. I would only have to add that there's a lot of different entry points and places where change can start to occur. And there's certainly change that can come from sources of capital. That means both angel investors as well as funds and venture partnerships. But there's also a cyclical nature to venture capital where wealth is created and flows, and once it flows somewhere, it can be recycled and sort of reinvested. And so one of the things that for example, I've been focused on and we've been focused on is not just look at diversity of teams and diversity of who's making the investments, but also diversity of actually who's writing the checks, and having access to opportunities to deploy capital in deals that have been gatekept for a long time by insular communities and groups of people means providing the opportunity for that wealth to flow into communities that are then able to redeploy it in ways that hopefully have a lot less of that explicit or implicit bias and sort of racism and other forms of othering that the very insular venture community, as it's been, has been a victim of.
I think Ed and Lorenzo and everyone have made a lot of the points that I was thinking of, but one that I wanted to add into the conversation is just the level of risk tolerance that's needed to go out and start a venture. And some of the rules of the game that say, for example, you have to quit your full-time job before you can get any investment. That is something that oftentimes holds folks from diverse communities back, because maybe they're the first in their family to have a high paying job, and maybe they're taking care of more than just themselves. And so it's a big risk for them to go out and quit their job before they have something that's surefire. And so I think one of the things that can be done is that investors start to reevaluate the rules of the game that have governed this world for so long, and have more tolerance for the ways or the reasons why folks from diverse backgrounds may have a little bit different entry point or have a little bit different ideas of how to get started, and have some tolerance for that. So I think everything else is spot on, especially want to reiterate the point about the fact that a lot of it is structural. A lot of it has to do with the fact that there is racism still, there is sexism, there is homophobia, and those really still dictate a lot of the decisions that are made in this industry.
And can I just add to Jules' point, which is a great point. So I'm on the board and have been for years of an organization called Black Women Talk Tech, and we released a research report, which I had no involvement in the authoring and researching of, but it's great. 91% of Black female founders surveyed said they had another job. And I know that when you get your MBA, one of the things that you're taught when you study venture capital, because I've been teaching venture in the MBA program at Columbia for 17 years, one of the things that you're taught is founders have to have skin in the game. And so they need to quit their day jobs and really throw themselves in and put themselves at risk. There is a racism created wealth gap in America and elsewhere. And so a founder who is working part-time and putting their reputation on the line and putting their life into it is still putting themselves at risk, I would argue disproportionately relative to a founder whose familial affluence gives them a safety net, whose academic credentials, often paid for in full by family, gives them a safety net. And we really need to examine the rubric that we've been systemically applying for venture funding to look at why we think that Harvard or Stanford means that you are going to be more successful, why we think that someone who's working 3 jobs has less grit than someone who quit their day job and started a company in their dorm room.
Absolutely. And I think, those same dynamics, if we're talking about other diverse voices around the table in terms of who is writing the check, those same dynamics follow through into the GP level as well. If you're talking about, 2+ years fundraising, 2% GP commitment, again, that excludes big parts of society. And so, of course, you end up with certain types of people around the table, and then that follows through with what we've been talking about in terms of who then which companies then get invested into. So I think this is all really good point. I'd like to, and I think actually, Lorenzo, you started to mention it, and so I think this is a good opportunity for us to talk about this. I mean, the title of this panel is specifically around venture capital funding, but obviously there are lots of other types of funding available. And so it'd just be interesting to hear your thoughts about other types of capital that founders in general, underrepresented founders specifically, should consider. And also just to get a bit of a sense of the timing of those things, because I think, we're kind of told that venture capital is it, and everybody goes for that. But actually, there's different points in your kind of founder journey. There may be different kind of types of capital that are more relevant or are, something that's worth seeking. So I'd be interested to hear some views on that.
Yeah, I mean, I often sort of start by saying, especially in talking to entrepreneurs or anyone starting a company, that first of all, not every business is a venture type of business. Venture type of investment is kind of gasoline poured on a very high velocity and high temperature fire that needs to burn bright and sort of grow very, very fast, often ahead of its own metrics. And sometimes that's the right strategy from a overall kind of business creation and market creation. Some other times it's not. But there's plenty of businesses that actually are better suited to slow and steady wins the game kind of sort of situation. I've loved seeing the innovation coming through into venture-backed businesses that actually provide funding sources for bootstrapped founders and bootstrapped type of businesses that are actually building in their growth into their revenue, finding non-dilutive, less dilutive sources of capital, often at this time when interest rates are so low, much cheaper in a lot of different ways. And if the business is well executed and it was a good idea at the right time, that actually generates significantly more control for the founder, and significantly even more wealth to be distributed across the founder and the employees of the company without it sort of flowing into, sort of the kind of high risk taking sources of capital that then, because of all the dynamics of funds needing to deploy capital, needing to raise another fund, need to be deployed so fast by companies and return and either go to zero or try to hit for the multiple $billion exit. Besides the fact that venture capital is the game of put money, grow, and sell or go public or create an exit. Which may also not be the type of business that an entrepreneur wants to build, and something that generates value for its stakeholders for a long time, maybe the better suited solution there. And there's more, but I think that's a good starting of the conversation.
I mean, as a pre-seed investor, we co-invest a lot with angels and angel syndicates, and I think angel investing and angel support, I think, is underrated. Sometimes it's you may want to go with the J curve growth plan, but you may not know how long it's going to take you. You may need a few iterations, and I think angel investing gives you that time to be able to figure that stuff out before you decide, if you decide to go for high growth sort of VC capital, which has a lot more pressures attached to it, and they come with emotional investment networks, value add, that can obviously VCs come with it as well, but they give you time and they give you their emotional investments from day one. So I think it's worth exploring that world as well.
I'll add a few ideas here. I talk to founders a lot, and I always tell them my favorite type of investment is the investment that comes from your customers. And so kind of moving them in the direction to focus on sales and getting customer revenue is something that I always like to do. And I find that people are often distracted from actually going to get customers because they are attempting to fundraise and finding no success on the fundraise trail, but actually could just go sell the thing that they are building. So that's one thing. Another is research grants. So in the US, we have SBIR and STTR grants. I'm not sure what the equivalent is in London, but I'm sure that there are research-driven grants available for early-stage companies, and that is typically non-dilutive and allows the company to have some runway to actually do the research component of whatever it is they're building, and that's a great source of capital. And then you have corporations, and I'll give a little plug here for the work that I do at Google. We've been really intentional about getting non-dilutive funding out for Black founders across the globe. So we launched the Black Founders Fund last year in the US, and it's since been launched in the UK, in Brazil, and in Africa. And so that is, up to $100,000 in non-dilutive cash awards, plus cloud credits, plus ad grants, and that's available for Black founders. And actually this week in the US, we just launched the Latino Founders Fund as well. So we're expanding that work so that there is more capital available in the market, that it's not taking equity. And really, we think of that as kind of what has to happen in order to level the playing field, in order to make more capital available so folks can take those first steps and can quit their job and focus full time on the business before they go out to raise their first institutional round of funding. So those are just a few ideas, but the other piece is, I think, to Lorenzo's point, I believe there are more funds that are contemplating the idea that, and this is what we're doing at Collab Capital, contemplating the idea that there are multiple pathways to success, and it doesn't have to be the all or nothing, sort of the typical venture game where it's you win or you lose, and a win is considered only $1 billion outcome. What we suggest is that there's a lot of room in the middle, and we built a model where we can actually help founders go follow the path that actually is best for their business, instead of trying to, if they're not a multi-billion-dollar business, instead of trying to go for that, they can actually, have a great outcome in the, $10 to $100 million range. And so we've built this unique sort of hybrid model between venture and a profit share, where we can help companies actually get to the outcome that's best for them based on what the market says and based on what they're building.
I just want to underscore or amplify Jewel here, because I've personally invested in more than 150 venture funds as an LP, and through First Close we've done, as I said, 55 plus, including Jewel's fund, Collab, and we've also committed to Paula's fund, Impact X, and we're super excited about both of those funds. When Jewel first shared with me the model, I started to scratch my head because it doesn't really look like most other venture funds. And that is part of the concept that if you keep asking the same people the same damn question, they're going to give you the same answer. If you start asking extraordinary people who are not the same people, they will rephrase your question and give you a different answer. And Jewel was kind and patient enough. I know you're Anu at British Patient Capital. Jewel was Atlanta Patient Capital, to walk me through and explain why it was structured differently. Because I happened to be a board member at an HBCU, a historically Black college university in actually in Nashville, I have heard the stories of where our alums have derived wealth over the years. And Jewel's explanation of the kinds of businesses that she was also going to be including in her fund resonated with me because of my understanding of how the alums that have really succeeded financially have succeeded in businesses that are outside of the kinds of businesses the people I went to school with ended up starting. So that's to me, it was a really nice example of how someone super smart and creative was innovating in the deploying and sourcing of capital itself, rather than just by virtue of the companies that Jewel and her co-founders are supporting.
Can I also add, first of all, agreeing with everybody so much with what's been said, but there is also an interesting shift that I've certainly seen. First, it happened sort of all of a sudden in terms of a possibility, and now it starts to actually shift a little bit in the way it's been looked at, which is equity crowdfunding. And there is, for entrepreneurs and for founders, there's obviously been now for, I think, close to a decade, a set of opportunities to raise capital from a large number of non-accredited or less accredited investors in various different ways. But initially, it was always there was always this kind of almost like a black mark on a company. You could see it in the venture community of companies that actually went that route, and often great companies would stay away from sort of equity crowdfunding because of the fear of having been seen as having resorted to something that determined, the fact that they couldn't raise capital in any other way. And I think that a little with the tide shifting, a little with some examples, and a lot with smart people kind of thinking through this, they realize that much like what Jewel was saying, I love to see your customers invest. Yes, they can certainly invest with sales. Those are fantastic. But sometimes, venture type of businesses need to put the capital in motion before they have anything to sell. And what they have to sell is effectively the vision and the promise for a future return. And when there is an intrinsic sort of match between a type of business and a community of an audience and a community of potential backers who will turn into customers, who will turn into ambassadors, that actually can be a huge boost for a company. And going the equity crowdfunding route can actually be a really smart thing to do for the business. And I'm now seeing it with companies that are very much able to raise venture capital traditionally to add, not just because they need a little bit extra capital, and that always helps, but because they are building this group of ambassadors who have stakes into the business and in its success, and that propels them to their growth.
We actually see this as a positive signal, especially for anything that's sort of B2B2C, B2C, where it's a really clever marketing strategy. So yeah, we're very happy to sort of lead the round on the terms, but the entire marketing of the deal is kind of presented as a crowdfunding opportunity, because it's in the best interest of the brand in the end.
I love that idea. I talk with a lot of different entrepreneurs that have a vision and they feel like they've identified a problem and they feel like they're going to build the perfect solution. And it's hard to know sometimes. I'm not a rocket scientist. I'm only as smart as the entrepreneurs I'm working with. And so I always like to tell them, how do I know that somebody's going to buy this product besides your mother, right? And equity crowdfunding is a wonderful way to validate that there is a customer demand and that they are willing to pay.
Yeah, absolutely. And I think at the Fund London, we invested in a company that also did a crowdfunding as part of that same round with some other VC investors, called Black Ballad, which is a kind of media and data company that specifically is for Black women. And that's exactly what they did. They had this community of Black women who were really invested and who, really love the company, and they were able to raise there in a way that I think it was very challenging for them in other senses, because having a company that's very specifically targeting the Black female community is not something that most VCs in the UK are familiar with or are even interested in. So, I think it's absolutely a really kind of good and practical and possible way for underrepresented founders to raise, especially those that have that kind of community that is really invested in them. It's a really good point.
One thing to just note on the equity crowdfunding, and I'm obviously also a lawyer. It has been something that enables people to sidestep some of the systemic barriers to closing the wealth gap. In the US, for the most part, unless you are an accredited investor, meaning you have hundreds of thousands of dollars in annual revenue personally, or that you have $1 million or more in assets personally, you can't invest. And so a lot of the wealth creation that you might otherwise, that people can get through angel investing, goes away or is precluded for folks who are under those paternalistically set by the government arbitrary thresholds. With crowdfunding, you're also seeing equity crowdfunding. You're also seeing an opportunity to participate in the upside, an opportunity to support. We, as a law firm at Lowenstein, were proud, for instance, to have represented Arlen Hamilton in Backstage Capital, a longtime client and a fund I'm invested in the equity crowdfunding they did through Republic, which was kind of an historic deal. And the excitement that generated also was validation of the strong sentiment, because one of the things that we don't often talk about is the depth of brand loyalty, right? We talk about the number of people, but there are some brands that just generate, and I'm not necessarily a fan of Harley Davidson, but when human beings are tattooing your brand on their body, that demonstrates the depth of the brand loyalty.
Absolutely. And I think we started talking a little bit about the US and the UK and some of the things that are happening there. Jewel, you mentioned things you're doing at Google for Startups are doing across those geographies. And I think it would be great to discuss a bit more about some of those opportunities and the differences that you see in the two geographies. And I know many of you here have invested and are involved in both, so it'd be great for you to give your views on that. Should I go to someone first? Paula, do you want to kick off? Oh, you're still muted.
Okay,
There you
sorry
go.
about that. Sure. I think that the comparison of the London market versus the Silicon Valley market, or the European market versus the Silicon market, is always a fun conversation to have. I would say that that the London market is a little bit younger than the Silicon Valley market in terms of its stage and maturation, which for me is what makes London a little bit more exciting, because the younger the market is, the more opportunity there is for growth, right? I looked at some numbers that looked at Silicon Valley, which some people say was really launched in 1942, with some government funding as well as some funding out of some research projects in Silicon Valley. And over that time, if you look at some of the most successful funds, they've generated, like, I think, a 20x return over, a 40-year period. I mean, the numbers are astounding if you got in early, right? And there are individual investments that have also generated successful returns, but the market as a whole, I think it benefited from its early start in the 1940s. Well, I believe that London is a little bit earlier on that spectrum, and I think that this London market also has the opportunity to generate a 20x return over time, in terms of the market as a whole. The other thing I think about a little bit, where you sort of started the conversation, Anu, is there is a established infrastructure in Silicon Valley, combined, if you listen to Gary's video, combined with venture capitals, universities, research institutions, and the entrepreneurs itself. And so there is an established ecosystem, which we all have talked about, the biases that exist. And so if we can replicate that sort of ecosystem in London in a more open and transparent fashion, I think it would be huge in terms of being able to advance entrepreneurship and generate outsized returns for investors.
I'll just add one thing, which is, of all the terrible things that have come from the last 2 years of global pandemic, one that might have just been, the sort of instrumental to a complete change of how things are, is the disconnection of geographic location and capital moving. I couldn't tell you, of the many startups that we've funded in the course of the last 18 months, I couldn't tell you most of them where they were when they were pitching, like the fact that entrepreneurs are able, in a few sort of round of interviews and talks, to meet with investors all over the world without having to travel, and actually successfully raise money, because the social barriers, they were all, like, the technology actually has existed for much longer than the last 18 months, but the social constructs and barriers that were like, oh no, you have to come to my office on Sand Hill Road or whatever it is, the fact that those were gone has been an enormous equalizer of some level of some aspects of inequity that existed because of geographic location.
Yeah, I want to, plus one to that idea. It's something that's actually informing my partners and I as we're thinking about our next fund. We, for this first fund, are strictly focused on US, but we've gotten so many great companies to come to us from all over the world, and Black founders in particular, who are looking for funding. We're already having conversations about, how do we adjust the remit for the fund, for the next fund, to be able to write checks into companies that are, in the UK or in Africa, because we see that there's just so much opportunity, and still there is this disparity that exists for Black founders who are raising everywhere. And so we want to be able to address that as well. And so it's to your point, it's something where the globalization and the ability for folks to raise money wherever they are is something that, is definitely, the pandemic has shed more light on, at least for me and for my partners.
So on the LP front, it's been fascinating. I've been coming to Europe and hosting events for our Venture Crush platform for years, and I've been personally investing here for years and doing deals as counsel, representing European funds and startups. And US LPs have been allergic, and not just allergic, like allergic with an anaphylactic reaction to European venture funds, with maybe one or two exceptions. And we're now seeing companies like Hopin, and you have a fund like North Zone, which invested early in Hopin, or UiPath and Credo Ventures in Prague, which, I don't know if that fund one is going to be a 20x return on the entire fund, just because of UiPath, though they also have other great companies in the portfolio. Blossom Capital, Ophelia Brown's fund in London. You're seeing these amazing outcomes. Seed Camp is another one, where US LPs, I hope, will look and say, I don't know why we have missed out. And the same is certainly true of the companies themselves. And we also see even within Europe, obviously there are British funds that will say, we cover Europe, but Lord no, we won't do a deal in France because it's too complicated. And so we've been seeing some shifts in those areas, and there's certainly a similar geographic set of biases in the States, and deal terms are different, and valuations are different, and exit opportunities are different in some of those different geographies. The fact that there are so many angel investors clustered around geographies is really helpful for the folks who start companies in those geographies, and that's another one of the dividends of the silver linings of the pandemic, is it has been a little more of an equalizer. Although I still see among American investors at the LP and venture capital level, they will say, "There's so much opportunity here. Why do I need to look across the Atlantic?"
Yeah, absolutely. No, all very good points there. So we want this panel to be obviously very practical as well for any of the founders that are watching this. And so it'd be great if you could all, I'll take you around in order, just let founders know how they can access capital either through your firm or through firms you work with. What are the opportunities available to them with the firms that you're with? So I'm going to take a reverse order from the intro that I did. So I'm going to start with you, Paula.
Sure. We're easy to find. Our website is www.impactxcapital.com. That's impactxcapital.com. You can go to our website, and there's a client intake form where you can enter information about your business plan, and it asks a series of questions so that we can get a sense of the business that you're trying to build. And then once you've completed that form, you will receive an invitation to schedule a meeting to talk with our Chief Technology Officer, is H.E. Britton, and those are the first steps towards getting together with ImpactX Capital. And I want to just say one thing. We've worked really hard to democratize capital so anyone can access the form, anyone can fill out the form, and anyone can go and basically provide a written pitch for their business.
Fantastic. Thanks so much, Paula. Lorenzo, I'll go to you next.
Yeah. So we're also really easy to find. The website is gaingels.com. People can write to me directly. My email is lorenzo@gaingels.com. I'm super accessible on Twitter and on LinkedIn. We always talk to founders at all stages. So we'll invest even very, very early, even though a lot of our investments also are into later stages of growth. And we also encourage anyone who maybe is already started a business or thinking about starting a business to join our community. You don't have to be an investor or desiring to be an investor to access things like educational opportunities and networking opportunities with our entire Gaingels community. And they can do that directly from gaingels.com/join.
Great. Thanks, Lorenzo. Ed, you next, please.
Yeah, I just want to start by also commending Lorenzo, because he's done so much to facilitate funding and community for the LGBTQ founder and investor community, and has gone almost an hour without mentioning that he also co-founded StartOut, which is a fantastic organization that we have for years supported, through which founders and investors who are LGBTQ or who want to really support the LGBTQ community can get together, can do pitch competitions, and just, if you think about someone who has had such a varied and successful career, and he also has these artistic endeavors on Broadway and elsewhere, Lorenzo is someone that I admire tremendously and have had the pleasure of knowing for years, and of spending time at the White House with. So he's very humble, but I would encourage people to seek out Lorenzo and to look at the body of work that he's done as a successful serial founder with exits as well. So I just wanted to throw that out there, because
well, thank you. The love fest is mutual.
So from where we sit, for first close partners, we direct people to an intake form on our website so that we can get information before making a decision about whether to look at the venture fund. And we do that. I know it sounds impersonal. Part of why we're doing that is we're done with warm intros. We're not preclusive of warm intros. We do not want to prioritize them over cold outreach. So to get the same data from everyone that enables us to start the process and create a queue has been something that's important to us from an equalizing things perspective. And like Lorenzo, I am very accessible on Twitter. And my email is on the Lowenstein Sandler website as well. And because we do our Venture Crush events, we're happy to include people in those events. And if folks want to be included, they can just shoot me an email, ezimmerman@lowenstein.com, or DM me on Twitter. And then finally, I would really encourage people to consider the funds that we have backed through First Close Partners. All of those funds have GPs who, by both headcount and economics, are 50% or more underrepresented. That's our mandate. So, and it's global. So you can take a look at the list of funds, or folks can shoot me an email and I'll send them the list of funds, and go directly to those funds. And you will see Jules' fund and Paula's fund on there as well.
Great, thanks, Ed. I'll go to you next, Emma.
Yeah, so same thing. Our website is quite simple to access. It's ascension.vc, and then I respond to all LinkedIn messages as well. Just simply a small summary of the opportunity, and maybe a summary pitch deck, and I always respond. My personal interests and the funds I managed are social impact funds. So if it's impact, I'm the one who would probably look at it. Otherwise, I would be passed on to one of my colleagues on the generic tax efficient funds. But last year during the pandemic, actually, we created an online pitching competition in partnerships with other VCs called the Debut Sessions, and it's got its own website. It's debutsessions.co.uk, and it's a completely online pitching competitions that the applications are open right now, actually, and it's completely transparent. All other investors can actually look at the deal flow coming in. It's open source, and during the day there's a whole load of sort of masterclasses and content that is then saved on the website and accessible for all to see. Things like raising funds, writing a pitch deck, term sheet negotiation, that kind of thing. And there's a new ASA sort of structure that we developed for retail investors with a minimum ticket of 2K to get in on the deals that win in those competitions.
Great, thanks, Emma. And lastly to you, Jewel.
Yes. So for those who are interested in Google for Startups, please follow us on social media, Google Startups. And specifically, we have a channel for UK, Google Startup UK. I want to give a shout out to my colleague who runs our UK office, Marta Krupinska, and another colleague, Rachel Palmer, who have been doing great work on the Black Founders Fund in the UK. So they would be really good resources for those of you who are joining from London. And also on the Collab Capital side, you can find us. Collab.capital is the website. We also have a open form for people to apply for consideration for funding. And I am at Jewel Melanie on social channels and pretty active, mostly on Twitter. Not so great on LinkedIn, but I am pretty active on Twitter.
Fantastic. Thanks, Joel. And for my part, with the fund, if you are a pre-seed founder and you're raising a pre-seed round, you can email me at anu@thefund.vc. I'm particularly interested in underrepresented founders. And then on the LP side, if you are raising a fund and you are interested in talking to us about that, the website is britishpatientcapital.co.uk, and there are kind of all the details about what we look for and the kind of email address for the proposals inbox. Everything goes into that inbox. Everything gets responded to. And then I think the last thing I would also say is, if you are someone who is thinking about a kind of novel way of tackling some of these issues that we've talked about today, to get in touch with British Business Bank more widely, especially the strategy team. And again, that can be done through the British Business Bank website, british-business-bank.co.uk. Very interesting web address there. But that is another really good way of helping us to think about the kind of supply of capital that's needed, not just the demand, and kind of and thinking about new ways of approaching the market there. So please do get in touch if you have any innovative ideas about how some of these things that we've talked about can be tackled. So with that, I'm just going to say a big thank you to all of the panel. We are just over the time that we were supposed to go to. I don't know if there are any questions. If there are, then maybe Gary, you can, if there's any burning questions, you can field them to us. But if not, then we'll end that there. So thank you so much to the panelists, and thank you to everybody for watching this.